So let's begin with the big issue. Our market calls for a rate cut, primed for disappointment.
There's scope and room for the Fed to cut
rates.
Rate cuts. Distribution has really shifted from hikes to cuts.
The most likely outcome is for a cut.
More likely a cut.
Perhaps just one time this year.
Down the road, but not soon.
What I worry about is that the markets only want to hear the word cut.
Relative to what the market's pricing at the moment, it seems like it's unlikely that the Fed is more dovish than market expectations.
The dot plot still has rate increases.
The Fed is not obligated to deliver the rates that the market wants, and it doesn't look like they're going to do that anytime soon.
The disappointment level could be really quite high.
Joining me around the table here in New York to discuss, Peter Tchir of Academy Securities, Andres Garcia-Amaya of Zoe Financial, and Steve Auth of Federated. Peter, let's begin with you. Your thoughts?
Yeah, I think the market's way ahead of itself on rate cuts. I think we're going to need to see months and months of bad data. And so far, we're not really seeing any bad data. I think if we wind up in a full-blown trade war, cuts might have to be, but we'll have much bigger problems to worry about that.
Steve, do you agree?
Totally. We didn't have any more rate hikes way back in December when everyone was worried about it, as you know, Jonathan. And we also don't think there's any rate cuts for it. I mean, our economic forecast is close to 3% for this year. So if we're on track with that, there's no way we're getting
up by 3.
Absolutely. Not above 3, a little under 3, but close to 3. And the way I look at it is the Fed's got our back. If this trade war really does cause an issue, which I think it won't, but if it does, then we'll get the rate cuts.
Andres?
I think the concern here is that we are assuming that if they do cut, that's going to magically also just cure all ills. If you look at the last time in 2006, when basically at the end of their hiking cycle, they were at 2.5 real rates. Right now we're at 0.4 real rates. I just don't think there's enough juice for them to do anything. I mean, they would have to do another QE if you really want to get things going. I mean, from 2.5 to 0, that's really not going to move this.
So my next question then, Peter, is how vulnerable is the front end of the yield curve right now? You guys don't think that a rate cut is coming. This market essentially is priced for one. How vulnerable is the Treasury market?
I think it's fairly vulnerable. We've also seen a lot of people push into long Treasury positions. Everyone's really using it right now in what we call risk parity light. So people are buying Treasuries as a hedge, whether it's at the front end or the long end. So I think it's kind of susceptible to a pullback on any good news.
Andres?
Yeah, I would agree. And I think the market overall, not just the equity markets, but I was even just looking at high yield. This trade situation, which I'm sure we're going to get more into,
yeah.
I think the market's pricing as a done deal that something's going to get done. Even though things have clearly escalated, the market's saying it will get done. And I'm not sure if that's 100% done.
What do you think about that, Steve?
I think there's going to be a bid under the short end as long as the trade issue is out there. I think people are a little disappointed. I don't know, Andres. We thought this deal would be done by now.
Yeah.
Now I think we're in a kind of push-out mode for sure. It doesn't seem like anytime soon now.
We're 3% from all-time highs, though, right? I mean, we're still in double digits.
Well, the market's going to be fine. I agree.
And high yield spreads are what, 400 basis points over? It's not massively dramatic, Peter, but we have had a decent move over the last couple of weeks.
Yeah, I think we've had a bit of a pullback in stocks, just a small bit. We kind of turned negative in mid-April on trade from what we were hearing. And my concern is really that, and it could be good or bad for the U.S. in the long run. Yeah. Back in December 2017, the executive branch declared China, quote unquote, a strategic competitor. That was a big step, and we've done nothing about that. I think there's been a lot of signs in the last month or so that we are actually taking that seriously. And if you look, we bump into China everywhere across the world. Iran, us versus China to some extent. Venezuela, same thing. Taiwan, a little bit there as well. So I think we might be taking a serious hard look at China and deciding to dig our heels in. And we could be in for a year or more of this trade war, and it could turn into an FX war.
And yet there is so much comfort that the Fed will have our back throughout all of it.